So Silicon Valley Bank just collapsed when customers started withdrawing their deposits in large numbers, leaving the bank with insufficient cash reserves to meet the demand. Now, to address the situation, the bank was forced to sell its bond portfolio worth $21 billion before the maturity, incurring a loss of $1.8 billion in the process. Now, this happened because the interest rates are very high, causing the bond prices to drop. In addition to that, the bank was earning a low interest rate of 1.79% on its US Treasury security investments, while it had to pay more in interest to the depositors. Now, to raise the capital and recover from the crisis, SVB announced its plan to sell $2.25 billion in common equity and preferred convertible securities. However, the announcement did not go down well with investors, and the stock price dropped by whopping 60% on Thursday. Now, this triggered more panic and led to a run on the bank, with customers fearing more withdrawals and the need for even more capital. Now, let's understand this in detail. So a typical bank takes in deposits from customers who could be individuals like us, or businesses or companies, and then it invests the most of those deposits by giving out loans, buying equities, bonds, and etc. However, they keep some cash on reserve for when a depositor wants their money back. Now, in case of SVB, their deposits came mostly from the startups and companies, and most of that were part of a tech sector. So for example, a startup raises 10 million or $100 million from a venture capital fund. They will then deposit that money at the banks like SVB, but often for a short period of time, as they may need that money to fund their business anytime. Now, typical banks, as I mentioned, give out loans from those deposits, whereas Silicon Valley Bank deployed those billions of dollars into US Treasury securities, which is treasury bonds, bills, and notes. So ideally, there is no credit risk, and these US Treasury securities pay fixed interest rates at which you bought. So the question is then, what went wrong? So most of those typical banks have many small depositors who won't need their money suddenly, whereas due to the concentrated customer base of startups and tech companies, SVB saw a large number of withdrawals from depositors. And to give that money back, SVB sold on Wednesday $21 billion of bond portfolio consisting mostly of US Treasuries at a loss of $1.8 billion. But why at loss? So the bond prices and interest rates are inversely proportional. So due to the higher interest rates right now, bond prices tend to be low. And if you sell those bonds before the maturity, which is typically 10 years, you will experience a loss. Now, the yield of that portfolio was around 1.79%, which was very low compared to current 10-year treasury yield of around 3.7%. So the problem with the long-term bonds is that when interest rates are high, the value of old bonds goes down. That still pays the old interest rate, which is 1.79 in this case. So two issues here. First, they were earning 1.79% in interest compared to what they have to pay on the deposits, somewhere between 3 to 4%. So they were losing money here. Second, they had to sell those bonds before the maturity at a loss of $1.8 billion. Now, at that point, the bank would be left with illiquid assets such as loans, leases, properties, and equipment. These assets do have value, but it would take time to turn them into cash. Now, to fund that hole on the balance sheet, SVB announced on Thursday that it would sell 2.25 billion in common equity and preferred convertibles. On that day, the stock was down 60% as investors freaked out that the more deposit withdrawals mean more capital to be raised. And as per the data, by end of Thursday, customers had pulled out a massive $42 billion in deposits from the bank. So the situation escalated into a domino effect as more and more customers rushed to withdraw their deposits, leading to a run on the bank. Now, what will happen to the customers whose money is stuck in SVB right now? So the FDIC, Federal Deposit Insurance Corporation, provides insurance for deposits up to $250,000 per depositor per insured bank. So everyone will get up to $250,000 in the account. So what are the key takeaways from this situation? So first is, for banks, trust and confidence are as important as cash. The second is, any business including banks should have diversified customer base. In this case, they had concentrated customer base of startups and tech companies. Third is, understand how quickly your depositors can demand their money back. Understand how quickly your assets can be converted to cash to meet those demands. Most of the time, long-term assets usually lose their market value when the interest rate rise. So thank you very much for watching this video. If you like my content, please do like, share and subscribe the channel. If you have any questions, feel free to ask me in the comment section. Please consider this video is just for an educational purposes and please do not consider it as any recommendation.